So I don't know if you can see me or if the screen is recording, because it won't let me see that for some reason. Anyway, this was a presentation that I was going to give at the team meetings but ran out of time. Just a very quick one on how you can calculate ROI, which is return on investment properties, so things like flats and shops and all that good stuff, which I think we may well see more of coming to the market next year as people try and divest some of their portfolio to pay for their heating bills, for example. So, what is ROI? Stands for return on investment. Generally defined as the ratio of net profit over the total cost of the investment. So basically, how much money are you making relative to how much money are you spending? The higher that number, the better the return for the investor. So 1% isn't very good, 20% is very good. In general terms, the return has to be better than, for example, the return offered by leaving your money in a bank. So until very recently, interest rates have been at an all-time low, so you don't earn any money by leaving your money in the bank. You probably get 3 or 4% return if you put it into equities, into the stock market. You might get more if you put it into more risky equity investments, but you won't get any money by leaving it in the bank. That's changing slightly as interest rates are going up, so you are starting to see more banks starting to offer a return via interest on kind of current accounts. So in terms of property, which is what we're dealing with, it's essentially the annual rental return of the property divided by the total cost of the purchase, multiplied by 100 to give you a percentage. So it's quite straightforward in theory. So if we give you an example of the kind of thing that you might get, which is a shop with 3 apartments above it, 2 of them are currently rented out and 1 needs to be renovated. What I have done is I've knocked up a little simple spreadsheet which I'll put on the comments underneath that you can link to and take a copy of if you so desire. That will give you the kind of calculation for that. So if you're looking at return on investment for that property that we mentioned, say for example you're working on a purchase price of €125,000 for that property. The agency fees are, for the sake of argument, 12,000. I can't remember what the percentage is off the top of my head. Notaires fees are roughly the same. Annual insurance for that property, 700, say. Tax foncière, 700. We'll leave renovation costs for the moment. There's always going to be an element of maintenance on a building, annual maintenance costs. That's the kind of thing you need to discuss with the buyer in terms of what they think that would be in order for them to make an offer. But if you say, for example, €1,000 per year to replace an oven or do a bit of wallpapering or what have you, that gives you a total purchase cost of €151,400 in this example. Say, for example, you can rent the shop out for €400 a month. And say you can get €300 a month, well, say €400 a month each for the 2 apartments. So that's 800 a month for 2 apartments. And then if you say that those properties, those apartments and that shop will be rented out, you could say it'll be rented out for 52 weeks of the year, but that would probably be unrealistic. There will probably be downtime between tenants coming in and out, you're doing bits of work on it. So if you were to say 48 weeks of the year, that gives you a total revenue on that property of €13,292 and a total return on investment of 9%. Now that's quite good. That is a gross figure. So what that means is that's the figure before you take off any cotisation or income tax or whatever taxes the owner has to pay, depending on how they've structured the company that owns the investment. But what you could then say, if you're looking to persuade someone to buy the place, is look at that empty flat that needs renovating. Say, for example, that flat costs you €4,000 to get up to a point where it's ready to be rented. That takes your purchase cost up to €155,000. Doesn't really affect the return on investment. But you now have 3 flats to rent out at 400 a month instead of 2. So you change that to 3 flats. That takes your return on investment up to 11%, which is a much better return than 9, obviously. You're looking really to be certainly above 8% gross, because you'll be losing kind of roughly half of it on taxes and all that kind of stuff. Plus there's an element of risk involved with people not paying rent, people squatting, all that kind of stuff. So the risk involved is much greater than just leaving the money in the bank, but potentially the returns are higher. So that's that. We'll leave a link to this spreadsheet. You can do what you like with. Put it on your Excel app on your phone if you're out. If you want me to turn it into a proper app so you can have an app that you download, then let me know and I will have a go at that. Shouldn't be too difficult. Any questions? As usual, just shout. Cheers.